This is the Trade for a Living podcast, and today I'm going to talk to you guys about demand zones, why they matter, and what's the reason behind them. So if that's something that tickles your fancy, you know what to do. Hit the like, hit the subscribe, and let me know where you're tuning in from and whether you've been using them and how you've been using them in the comment section. I would love to hear and see how you guys apply them. So for me, the important thing is a demand zone forms when price drops sharply and reverses with conviction. It's future support built from past aggression. That's the simplest way to try and word this. So if we look at the price action, if that is where demand is, okay, there was aggression, future support for past aggression. If that is where supply is, okay, that whole zone, future resistance from past aggression. And the nature of the market works in that way. So what was a good price could potentially be a bad price in the future and vice versa. That's why when we want to trade, we want to be able to trade and buy within demand and supply zones. So today I want to show you guys how to use that and how to identify that. Now, for most, if you start trading, I'll take that away so we can get back to that, or maybe let's leave this one. For most, when you start with trading, this is how your trading view looks. You have the typical trading view colors. You have a moving average, one or two of those moving averages on the screen, and you're trying to figure out when to buy. Now, as the assumption normally works, guys would say, well, use the moving average as a support, and then the time you buy on the moving average, hoping that it turns it into support, it breaks down and fails and frustrates you. Môre, Kilian, goeiemôre, as they would say, goeiemôre, Rune. Altec Codes, good morning to you, my friend, and have a cappuccino. I see there, or coffee, I don't know. I don't drink any caffeine, so it's for me. Let's do some product placement. A BioPlus. That's how I stay awake. Okay, guys, and all jokes aside now, this is the way that we tend to want to learn to trading. So I want to show you an easier, simpler way to do that. So let's take away the moving averages and all the other stuff that might distract your attention from applying a demand in the supply zone. And the first thing that you want to do, or the first tool you want to use, is literally just an RSI. You don't need anything other than that. Load the simple RSI. Now you're going to say, okay, Rudo, where's demand and supply zones? The way that I got taught was by understanding that a candle opens at a point, then it will go and make a high, then it will come back down and make a low, and then it will close. And when it closes, it draws a little body, and that's a candle. Now, a demand zone has certain rules to them. So it will open at a point, it will go make a low, it will make a high, and it will probably close at that high. So you'll have a little fat body like this. And then one would draw from the close to the extreme, and this would be your demand zone. And then the same for a supply zone. So you'll have a candle wick up, come back down, end up strong, and then there's a little flat body like that. And then you will use that as your supply zone. But now, if that is the case, and this is how we draw them, especially if you're new to trading, you're going to find those candles everywhere. And this is the trader mistake. So there's a supply zone, there's a supply zone, there's a demand zone. You know, which is which? Now you end up with a chart drawn full of demand zones and more demand zones and more demand zones. And then which one do I buy? Where do I go to? Because now, okay, great. It's something that shows where aggression was, but there's so many places. It's almost like using the Gann version of what trading would be, meaning let's show you the infinite possibilities of all the trend lines. And then it by itself, it doesn't help you. It frustrates you because you need a strategy. Okay, so if we want to make some money before the end of the bear market, we need to, morning Dean, we need to just simplify this and identify the right demand and supply zones. That's why the RSI is very handy. So what I would suggest is just use the vertical line on the RSI and go, look at where we are right now. Bitcoin daily time frame, just click on the points where the RSI has turned around aggressively. It created a pivot. It's easy to see them. Mark those out. Once you have those marked out, those would be demand and supply zones. Now I made this little note here for you guys. This helps you time your entries, because if you look for when to buy a double bottom or double top, once you're testing those demand and supply zones within those points, you'll know when to grab the buy. And I'll show you now. It helps you with expectation management as well, because in the end of the day, when we get a good entry, we tend to want to see it run forever and then end up running it to the ground, maybe breaking and stop or losing, frustrating things as traders. So what we want to do is understand that if I'm buying an amazing demand, when I have the previous supply zone marked out and we're in that zone, take profit. The expectation is that more aggression will enter the market around that point. Those are the kind of things. So buying a demand and understanding where supply would be means that you now have the ability to trade a range. Another thing when you're new to trading that is sometimes very hard for new traders is support and resistance levels. I use demand and supply zones, these RSI pivots, to identify these support and resistance levels. Go to a line tool right there at the top and just mark those out. Those are the important support and resistance levels, because after all, it shows you where conviction was. There can be many areas on many time frames where support could be created or resistance could be created. But in the end of the day, if we're looking at the big picture and we want to have perspective, this is the easiest tool that you can use just to identify that, which means there was support, there was resistance, there was support, there was resistance. Now, let's mark that out. That's resistance, that's support, that's resistance, that is all resistance now because we've lost it. Then when the next trend happens, you now know when to be cautious and you know when to look for support, be aggressive or buy in on a specific trend. That's the beauty about it. So it shows you support and resistance levels. Then the nicest thing about this is it shows you where to draw your divergences. If you're new to trading, having divergences or trading with divergences is exceptionally hard because you get so many of them. There's divergence. There's divergence. There's divergence again. Oh no, there's harmony. Okay. And now which one do I pick? Because I understand where support is now, I understand when a divergence is actually playing out, and I understand when the market is weak and you need to take that specific divergence serious. That makes it easier. And the last little thing is, it's a nifty tool because it shows you trader regression. Now, the buddy indicator that I created, my buddy pro indicator, has got additional tools that shows trader regression. And I want to just show you how it layers and supports that. So I've got the buddy loaded right now, and it's busy calculating. So what I'm going to do is I'm just going to switch the whale trades on. And now you can start looking at, see there, that pivot, the market changed its mind. It tried to be bearish, supported by big whale bear volume. There's more bear volume and no follow through. So you can see that although we have bearish divergence, they couldn't get price below their previous point, but below support or resistance. They couldn't break through that level. Vice versa. So it allows you to have an understanding. So to get to the point on the headline is buying a double bottom or a demand zone trade strategy. It's on the basis that you need to have these principles locked in and then have a strategy to buy them and invalidate them should you want to trade. Okay. Now let's switch all this off, take this away. And let's talk about that real quick. There's a few people joining in live. This is what, 17 people joining in live right now. Guys, make sure to hit the like, hit the subscribe, and then share the video with a friend, okay? So if we look at this and we talk about the strategy, there's two frames of mind that we need to remember. One is the analysis. Now, there's many tools that we can use to do the analysis. I'm just going to do this there. Analysis. Okay. There's many tools you can do that. You can use Wyckoff. We can say, right, if you have your distribution and your accumulation patterns play out over a specific range, there's the upper end of the market. The phase B starts there. The shakeout, which is your phase C, trend within range. There's a whole distribution pattern sitting around that level. There's Wyckoff. Okay. That's an analysis. By itself, you can't really trade because you don't have a setup. The same thing goes for Elliott wave. One can go and say, right, Elliott wave. If this is an impulse going from the bottom 1, 2, 3, maybe 4, and then 5, with this being an ABC correction. So there's your 5, there's your 4, there's your 3, your 2, and your 1. Okay. And then your ABC, A with the B going higher. Sorry, guys. In this instance, and then a C, 1, 2, 3, 4, still need the fifth wave, 5. That again tells you just what could potentially happen. It's an analysis. Okay. It helps you with your bias. Should I be looking for a bull setup or a bear setup? That's all that this does. But having the demand zones and understanding that means that you can take a trade setup. It means that you can look at this bias. You can look at your bias and see how can I then exploit my bias. And that's what the goal is with demand and supply zones, is exploiting your bias. Looking at where people going to lose money trading what is obvious. Something is bullish, it's going to go up. You can see it's bullish. We want to be bullish, but people don't want to wait for the right buy zone. They don't want to wait for price to go test demand, and that's normally when they get their fingers burned. Okay. So the setup is simple. I'm going to load the RSI again. And what we're looking for is just opposites. It's a simple way, opposites. You've got a high, you've got a low in price. You will have a high and you will have a low in the RSI. It's meeting up. Then what will you have? Okay, you'll have a high and a low there, high and a low there. But clearly there's an opposite happening. This move goes 1, 2, 3, okay, 1, 2, 3, and this move goes 1, 2, 3, 1, 2, 3, okay. Now look at the middle. Look at the middle. And look at the tops. Are we getting lower lows, just like price, or higher lows? Once you have divergences like this, you can look for double tops, bottoms. Otherwise, you're just going to get a scenario where you're going to get wicked out a hell of a lot of times, because the market's going to give you these double tops and bottoms everywhere. Because as soon as you see the demand and supply zones, everything is going to look like a demand and a supply zone. So we now know, use the RSI. It makes it simple to point out these highs and lows. You know now to then use those areas as your points where you need to act. Let's zoom into that then and draw out those demand zones. This means that was a supply zone. It was at the high. RSI is now a little skewed, okay? This was a demand zone. close. This seems like my good morning, guys. And all we want to do is once you have these identified, supply and demand zones, is wait for the market on a lower time frame and trade within that range. So let's do this. Click there. Let me just rewind. It's going to be the easiest way to do this. I'm going to hit the replay button. I'm just going to move down there. And then I'll go to the 15-minute. The goal here is to look for double tops, double bottoms. I'm going to take away the RSI real quick, because otherwise the chart's going to be very messy. I'll take away all the brush strokes just to clean it up for you guys. And what I'll do is I'll just hide this. Here is where we marked out our supply zone on the higher time frame. So this is where we look for double bottoms. Simple as that. We've marked it out. The daily closed. Okay, I'm going to switch back to the daily, just show you where the daily closed. Automatic. Come on, go back there. There's the little arrow I was looking for. Sometimes it just disappears on me. Okay, there we go. So there's the daily. You first need to have the supply zone locked in. Right, daily close. Now you go on to the smaller time frame. Once that daily closes, a new day opens. There. Now you're looking for the test of that, the double top. And the simplest tool that you can use to do that is draw a fib on that box. 50% move. That's your entry. Stop above that level. It's as simple as that, guys. You've got a demand zone drawn here. This would be now a 4-hour. Let's zoom into another version of this. This is a demand zone, was created on the daily. Correct? Where did the day end? We can look at the dates, it's simple. It was drawn on the 22nd of November. So every other is a new day. So what do? Put your fib on that daily. And you wait for it to go to the 50% of that level. Demand zone test. Simple as that. That's how you trade your demand zones, guys. Be patient, wait for them, stop above that. Be patient, wait for them, stop above that. Now, there will be scenarios. Why do there have to be a stop? Well, because if a demand zone of this magnitude and strength, why is this a strong one? Because when it came there, it had a massive reaction. This would be a weaker version of that because it went back into that demand zone, but it gave you a very weak reaction. Weak, weak, weak. Strong reaction. When you have strong demand zones, okay, you want to make sure that your stop is on the outside, firstly. Secondly, you want to see that price don't fall below that level again. So now your invalidation starts getting tighter as the market moves. Now, when the demand zone fails, what inevitably happens? It shows you weakness in the specific direction or on the side that fails. Which means if I hit the play button for you guys and we fast forward this forward, what does it mean? Price is going to, at some stage, now trade higher and create a new area of supply. It's the same with the bullish side. If we were to now scale this to the daily time frame and look at this same movement, hit the play button. As soon as we fall through that, it's weakness. Now, in this instance, we fell through. We didn't even go back and retest. We just kept going. It happens. Okay? But that is your line drawn in the sand. Because the hardest part about trading, guys, is actually navigating lateral ranges. Because when we're in a trend, it's easy to make money. This is where most people make money. And then they lose it here, waiting for this low to be the one. Or maybe this low is the one. Maybe that low is the one. These levels are always going to be significant. They don't take, which means by the time we get to the one that moves, they're normally out of the market, sitting on the side, tired, had enough, fed up, screw this, I'll buy the next level. And then what happens? You go into that same zone again where it really hurts you. So simplify your approach regarding demand and supply zones, guys. And that will then help you move forward through the market without that analysis paralysis, that thing that people dread. It's going to go up, but I'm not going to buy now because there's something in me that tells me to stay out of the market. We all experience that bloody dreaded feeling. Okay. This means where we're at right now, bring in the RSI, simplify things. What do we have? We've got two pivots from the bullish point of view. There's one over there, and there's one over there where the RSI, I would say, created a little bit of a move. The reason I'm using that as an example is because as soon as we go into the 4-hour time frame, you can clearly see what I mean by that. Okay, you had your initial move, you had a secondary pivot, an important point in the market. Let's fine tune that. That's it. That's demand. Oh, don't delete the RSI. That's your demand zone, which means if price wants to remain bullish, this is the area where we cannot lose. We can't lose the zone. So your bias would be simple. Come back down to this level. This is where the demand will get tested. It's a strong one because we saw good results from that. Break this one, things turn bad quickly. There's your analysis. Now, what do you want to do when you want to trade this? In the demand zone, you want to look for around 50%, because normally that's how they will scatter and buy their support. The whales would position themselves to support their initial campaign. The same then is true from the bear point of view now. We have supply sitting right here at the top. Come on, there we go. Supply zone. If we want to be bullish long term, this level needs to be broken. So this is your long-term bearish level. This is your long-term bullish level. And now what we need to do is position ourselves and be patient, because this is going to keep on happening until what happens? One of these major levels get broken, and then the move is on. There you have it, guys. Okay. All the tools you need to trade, identify, and understand demand zones for anybody that is new to trading, trying to figure out things. Want to know where support levels are drawn, you can use it. And that's basically what I do when I look at my own analysis. When I simplify things, I'm going to go 4-hour time frame, just clean the setup for you guys. This is how I go about trading. Got my levels point out. I've got my divergence point out. I'm looking at where the market's going to go to. This was our area of sell yesterday. It went to my move your stop to break even, and then this morning it came right back. Stop now. So I'm not in the short anymore, frustratingly so. We're probably going to try and go long pretty soon. And then the higher time frame probabilities. All this is layered on the principles of demand and supply zones. Understanding where the whales are buying, where the divergence pivots are, where the real support and resistance levels are. Okay, there you have it, guys. So I want to do a quick shout out to today's sponsor. It is Bybit. Bybit allows me to make this content to you guys. And also what it does is it gives you all the necessary trade tool instruments. You can sign up, you can get deposit bonuses, you can come and trade with me. And it gives you the ability to gain access to my buddy indicator as a trial period. So if you've got a Bybit account, send me your user ID. I'll verify that, and then with your TradingView username, wherever you want to DM me, and I will give you guys access to my Buddy Pro indicator as a trial, just to check it out. Okay, simple as that. No questions asked. My private paid group is still there. There's still the discount, yearly subscription, $870. I don't want to show too much of the personal stuff behind there, but there's a few guys killing it in there, guys. And at this stage, I have to say I am really proud of them. I'm really proud of those guys. And it's using the systems I teach in the group. So it's as simple as that. It's not a signal service. It's a group where we work together, learn together, trade together in the end of the day. All right, guys. So make sure to take advantage of that discount. It's not going to be around for that much longer. There you have it. You guys have a lovely day. Looking at where we are today, I'm trying to buy a bottom here with Bitcoin. And I'm hoping that we will get a nice supply zone test there on the lower time frames. There you have it, a nice supply zone test, because we have divergence of some sort. So we'll see how the market's going to react. Okay, there you have it. Cheers, guys.